Buyers are backing out, sellers are delisting their homes. Everybody's taking their ball and going home. And this is sending one clear message. The real estate market is shifting quickly under our feet in 2025. So here are 5 red flags, 5 blinking red lights that you need to pay attention to that show the market shift is happening right now. I'm gonna break them down for you one by one and tell you what they mean for you, whether you're a buyer or a seller in 2025. So stick around to the end so you get all the information you need to make the best real estate decision you can for this year. All right, let's get stuck right into it with red flag number 1, and that is that buyers are pumping the brakes, and they're doing this in a big way. Nearly 1 in 4 buyers has said they're not making any major purchases this year. That is a big deal. That's no cars, no houses, no major financial encumbrances for 2025. So the obvious question is, why, and what do we do about it, and how does that affect you? Well, the why is really simple. It's FUD, fear, uncertainty, and doubt. The ongoing tariffs and trade wars, the political instability, and the financial instability in our country, which, if you're new to the channel, the country I'm talking about is the USA, is a big deal for people. People are worried about their jobs. They're worried about job loss. They're worried about their 401ks and their stock losses because we've seen so much volatility in the market. Technically speaking, as the recording of this video, we have recovered almost completely from the big stock market losses after the Liberation Day tariffs were announced. But that doesn't mean that didn't leave a mark. That doesn't mean that didn't scare people and that they're still not making decisions based on that fear, uncertainty, and doubt. So when you have new tariffs being announced all the time, when you have stock market going up, down, sideways, and every which way, and you can't tell what's going to happen with your retirement or your savings, and when you're seeing major job losses, not only for federal employees, but across the country, and you add to that some additional cuts coming from the spending bill that they just pushed through Congress that are going to mean, in large part, a lot of people in healthcare losing their jobs. You've got so much fear, uncertainty, and doubt out there that nobody wants to take on a big purchase. And that's got nearly a quarter of our buyers, 24% of them to be exact, saying, I'm not doing it this year in 2025. So what does that mean if you're a buyer? Well, if you're a buyer and you're one of the ones that says, I do want to buy in 2025, that will mean less competition. So in that case, it's actually a good thing if you are actually going to complete a purchase by the end of the year. You're going to have less multiple offer situations, less competition for each individual listing, and it could be a good thing for you as a buyer. However, if you're a seller, this isn't such a good thing. This means a contracted buyer pool, less people looking, more competition between you and the other sellers, and more downward price pressure on your listings. So this one is split between buyer and seller. Could be good for buyers, definitely not good for sellers. But either way, do I see this easing by the end of the year is the big question. And the answer is no, not really. That fear, uncertainty, and doubt is going to take a while to settle out. Even if the president comes out and finally says, we're done with all this tariff business, it's over, no more tariffs for the rest of the year, you can all settle down. You know, a hit dog still flinches if you move towards it quickly. And we are all a hit dog at this point after all of this tariff insanity. So it's going to take a while for people to calm down and trust that things are stable in the financial markets again. That's going to leave a lasting mark on our real estate market. So I don't see an easing of this where a bunch of new buyers come to the table all of a sudden and say, you know what, I'm going to part with a bunch of my money and make a big purchase right now. I'm feeling better. I don't see that happening for 2025. So I think this one sticks with us a while. If you're getting anything at all out of this video, hit the like button, click subscribe, and hit that little bell icon to make sure you get notified of all of our upcoming videos so you don't miss a video with crucial information to help you with your 2025 and beyond real estate decisions. It really helps the channel, and we're trying to give you the best information you can to make the highest quality real estate decisions you can from the comfort of your couch. All right, now back to our list of the 5 red flags I see in the 2025 real estate market. Red flag number 2 is that price reductions are on the rise. Now look, since the COVID insanity market, we haven't seen very much in the way of price reductions. And even when the interest rates went insane in July of 2022, we really didn't see massive price reductions after that either. They were a few here, a few there, but not en masse a lot of price reductions. But for June of 2025, last month, we saw 28.6% of all listings nationwide getting at least one price reduction or more. That's nearly a third of all listings experiencing price reductions, and that is a significant change in the marketplace. Now, there's another trend that I talked about earlier about delistings that I'll go over later in the video. You want to stick around for that one that will explain why we're not seeing the price reductions being as significant as we would expect given the market mechanics. They're not massive price reductions in terms of dollar amount, but they are happening on a larger scale across the marketplace, which is a sign of a softening market. Now, price reductions are excellent for our buyers. Unfortunately, these price reductions aren't really enough to be life-changing or move the needle or increase the affordability level enough to be scraping a bunch of new buyers into the buyer pool. We're not seeing that level of price reductions yet. And to be completely frank, based on the fighting for balance and competing interests we have in the marketplace, which I think you'll understand better after you've listened to all 5 of these red flags, I don't expect to see massive enough price reductions by the end of the year to really change the level of affordability for most everyday working Americans, and that is a sad thing. We do desperately need reductions in prices and increase in affordability for homes in this country. I've been in real estate 20 years now, and this is the lowest level of affordability for homes I've seen in that 2-decade career, and it's not good for the country. It's not good for our buyers. So as much as I'm a homeowner myself and I don't want to see my home lose value individually, for me, that's not great. For us as a nation and as a people, having more people be able to participate in the American dream rather than less is beneficial for all of us. So I do think we need some bigger price reductions. Price reductions are on the rise in terms of number of them, but the amount of price reduction isn't at a point yet where it's life-changing, but keep your eyes on the market because I expect that trend to continue. Obviously, it's easy to see which way this one cuts. If you're a buyer, price reductions are good. If you're a seller, price reductions feel bad. But let me throw a little perspective taking into it being bad for sellers. And look, this is maybe small comfort if you're on the cusp of retirement and you don't have retirement savings and everything you have is in your house. You need every penny from that house to help you pay for retirement or pay for end-of-life care or that sort of thing, then what I'm about to say really doesn't matter. Price reductions suck no matter what for someone in that position, and I feel for them too. But as a seller, you're also going to be a buyer. And as a seller, you're also an American citizen. And we are at a point where real estate is just simply unaffordable for way too many Americans. And we saw massive appreciation through the global pandemic for our homes. So if you as a seller take some small paper losses right now, but it increases affordability for most Americans, and more Americans buy houses, and those Americans that buy houses go out and buy couches and washing machines and paint and things for the wall and backyard and sod and gravel and things to make the yard pretty, they move a ton of money around the economy. One home sale moves a massive amount of money around the economy and touches so many job categories in our country that even if you and I as individual homeowners take a little haircut on our overall appreciation, but it opens up home ownership to even a small percentage more Americans, that moves more money around the economy, and that makes all of our lives better. It makes our economy stronger, and it's good for all Americans. This is definitely a rising tide lifts all boats sort of situation. So as much as, of course, it sucks to see your house value go down, and we all want the maximum value that we can get out of our house when we sell, take it as a small comfort that whatever haircut we see on our profits on our home, that also is helping affordability and our economy as a whole to come back and to recover and to make the American dream accessible to more people. And I hope that is the result of any price reductions that we see over the course of 2025 and 2026. Right about now, you're wondering who I am and why you should be listening to me about real estate or anything at all, really, and that's a fair question. If you've made it this far in the video, thanks for sticking around. I'll tell you why you might want to continue listening to me. My name is Rich Curtis. I'm with EXP Realty, and I've been selling homes here for over 20 years now in markets ranging from the Great Recession to the COVID market insanity and everything in between. I work in 5 counties in Northern California, so when it comes to Northern California real estate, I've got you covered. But even when it comes to macro real estate trends and macroeconomic trends in the country, I've been doing this a long time. And my goal with this channel is to help you make the highest quality real estate decisions you can from the comfort of your couch. So if you're still willing to listen to me for a few more minutes, stick around. We're going to jump right back into our list of 5 blinking red lights, 5 red flags that I see in the real estate market in 2025, and how you should make your decisions according to these signals. Red flag number 3 that I see in this real estate market, and this is a big one: sellers are delisting at a massive level rather than discounting. Delisting rather than discounting. Here's why this is important. Delistings, meaning pulling your home from the market, are up almost 50%. To be exact, 48% nationwide delistings were up last month, year over year. That is a big, big deal. And what that signals is that sellers are not yet getting realistic about their prices. So we have downward price pressure due to the interest rates. We have downward price pressure due to the fear, uncertainty, and doubt in the marketplace. We have downward pressure due to some of the other red flags we're going to talk about, like inventory increasing. But the reason we're not seeing the massive price reductions that we would expect to see, or at least larger ones, is because sellers are just taking their ball and going home if they don't get their price. And here's why. Here's the difference. Think back to 2008, if you've been alive that long and paying attention, if you've got as much gray hair in your beard as I do. I was in real estate back in 2005. That's when I began. And around 2008, 2009, we had the biggest chunk of the Great Recession real estate crash. Now, at that time, sellers were sitting in their homes. They had either put zero down, or they'd put zero down and done a negative amortization loan, meaning they owed more on the home month after month. Every month, what they owed went up. They were just insane loan products, which caused that great bubble and that great crash. But what that meant was, well, I'm sitting here, I got no equity in this house. I spent no money to buy this house. My interest rate's 5 or 6%. That's not that great either. I'm just going to walk away. So we saw massive waves of default, of foreclosures. And a lot of them were strategic rather than necessary foreclosures. People saying, man, I'm never going to be upside right in this house. I don't have any skin in the game. I don't have any money in it. I'm just going to put the keys on the counter and walk away and be done with this thing. Why am I going to keep making this massive payment, right? Now, and the payments were bigger because they were 5 to 6% interest rates. Now, what's different today? The vast majority of Americans have a lot of equity in their homes. And in fact, people owning their homes outright now has climbed to 40% of the market. 40% of homeowners right now in the United States own their home outright, full equity. The biggest chunk of the rest of them have a lot of equity. And the ones that do have loans, most of them locked in those loans at pandemic era interest rates of 2 to 3%. So the math is very different. I have a lot of equity. I put money down when I bought this house, and I have an interest rate that I likely never will see again. Now, maybe my kids had kids across the country and I want to go live with my grandkids. I'll list my house, and then I get the message from the marketplace that I'm way off. Maybe I'm 50 grand off. Maybe I'm 100 grand off on my price because I haven't got realistic and noticed that the market has shifted away from pandemic era pricing, and I have a decision to make. Am I going to, in my mind, even though you're not eating that 50 to 100 grand, you never had it, it was paper gains and it's paper losses, but it emotionally doesn't feel that way. So am I going to eat 50 to 100 grand? Am I going to spend the money to move across the country, spend the money to sell a house on fees, spend the money to buy a house on fees, and buy a smaller house that costs more and that has a higher interest rate and results in a higher payment? Am I going to take all of those losses to move across the country and be with the grandbabies, or am I just going to buy a lot of plane tickets, right? A lot of sellers right now are saying, I'll just buy a lot of plane tickets. I'm going to stay put because I don't have probably another opportunity at my age in my lifetime to grab this much real estate at this low of a payment and this low of an interest rate. So they're just taking their ball and going home and pulling their listings. Now, what does that mean for other sellers and other buyers? Bad for buyers. All these delistings are bad for buyers. One, when those houses don't sell for less, we don't get data points and comparable solds showing less, and it slows or stops the price declines in the market. Number two, it means the inventory contracts again. Less inventory means more buyers for each property, which shifts that supply-demand curve and means that you are more likely to be competing with other buyers for the property you choose, which drives the prices up and creates multiple offer situations and insanity. You might remember all this from 2021. So people delisting at a massive scale, right, is not good for buyers. Now, for other sellers, this could be good news. This means you have less competition in the marketplace, that contraction of inventory, likelihood of multiple offers. So again, this one could cut to being good for sellers, but we're seeing this dramatically in different places across the country. So not as bad here in my main markets of El Dorado and Sacramento County, but take some place like Phoenix. Last month, Phoenix had 30 homes delisted for every home that was listed in the month of June. That's massive. That's a net 29 home inventory loss for each home that came to market. That's a massive and quick contraction of the inventory, and that causes prices, if not to go up, just to stop going down or to stabilize. Now that we're at this point in the discussion, you can start to see what I was referencing earlier about this push-pull, this fighting for balance in the marketplace. If sellers didn't have 2% interest rates, if sellers didn't have a boatload of equity, if sellers weren't taking their ball and going home, then most of the trends in the economy right now would be putting downward pressure on prices. We'd be seeing much higher rate of price decreases. So instead of say 30% of listings, we'd be seeing 50% or better of listings experience one or more price decrease last month, but we didn't. We saw 30%, and we'd be seeing the amount of price decreases get bigger and bigger month over month as we post up those sales that become comps at lower prices. Because that's not happening, because of this nearly 50%, it's actually 48% nationwide delisting trend, that is stabilizing the prices, and we're not getting that downward pressure that we would expect based on these other market mechanics. You can think of this as a market fighting for equilibrium, fighting for stasis, or for my medical folks out there, when someone has a heart attack, the heart goes into fibrillation, it just twitches. It's not in a bad rhythm, it's not in a good rhythm, it's just freaking out, trying to find a rhythm. And that's not good. They come in with the paddles, they try to shock that bad boy back into a good rhythm, right? Well, that's what the market's doing right now. The market is in fibrillation. It is fighting to find its feet, fighting to find its rhythm, and that is keeping any wild swings from happening. And so you get all these panic peddling headlines on the news telling you the market's dropping before your eyes. Oh my God, your house is going to lose 60% next month. And then next month you look at the data that comes out, or you watch one of my market updates, and I'm like, yeah, prices are about flat month over month. And you're going, well, what's the difference between what the news is saying and what's happening? And the difference is the news is looking at macroeconomic trends and applying standard lenses. When this happens, this happens. And they're not taking into account the fact that we are in unprecedented times in terms of the amount of equity people have and the low interest rates people have and the psychological lock-in effect that is causing. That is really keeping the market a little bit stuck right now. Look, if by the end of this video, your head's swimming and you can't make any sense out of this, and you have a specific question, a specific situation for you that you want information on, feel free to reach out to me via the contact information on your screen or in the description down below. Like I said, I've been helping people buy and sell homes for over 20 years now. And one thing I can tell you for sure, and there's not a lot of for sure's, 100% and definites when it comes to real estate, but one thing that's for sure is no blanket advice is good advice when it comes to real estate. Real estate is hyper local and hyper personal. So if you've hit the end of the decision-making tree or matrix that you can do with all of this general advice from the internet, go ahead and reach out via that contact information and let me dig deep into your personal situation. Let's come up with a personal plan that works for you and your family. All right, let's jump right back into our final red flags in the 2025 real estate market. Red flag number 4, mortgage interest rates remain high. Look, everybody is so hyper-focused on rates, but I would make the argument that now is the time to let go of the focus on rates because it is not the most important decision-making criteria in the marketplace right now. It's more important whether you have stable employment. We talk about this a lot on our Informed Home Buyer podcast, our 5 fundamentals. Do you have stable employment? Do you have an emergency fund? Can you make this payment at this interest rate no matter what? If the interest rates don't come down, you're not planning on a refi to save your bacon down the road. Do you have a long time horizon? You're going to stay in that property for more than 5 years. These are the types of things that you should be using to decide whether you buy in this market or not the interest rates, because they're not going anywhere anytime soon. They're not coming down massively or quickly. Here's what's going on there. Basically, the interest rates are at about, and we can't quote exact rates, it's highly dependent on you, but in a range, 6.5 to 6.875 right now. I'm probably 6.7 to 6.875. You'd be doing pretty good or spending some money to try to get it as low as 6.5 right now. That's where we are at. What will change that? Well, the federal funds rate coming down, which the news focuses on a lot, might change that, might not change that. That is the short-term borrowing rate. Mortgages are the long-term borrowing rate. The federal funds rate reduces the amount of money it costs people to borrow money at the corporate level from banks and that sort of thing. It is not a one-to-one reduction to your mortgage interest rate. It is really the mortgage-backed securities and the bonds market and the 10-year T-note that runs the mortgage interest rates. For example, if we saw, say, and these are predictions right now, we might see 2 to 3 quarter point reductions in the Fed by the end of the year. So that would be a 1/2 to 3/4 of a point reduction in mortgage interest rates, in federal funds rate by the end of the year. That would not equal 0.75 points in your mortgage rate reduction. If the Fed drops the federal funds rate 3/4 of a point, I figure we're going to see about a 1/4 point, maybe between 1/4 and a 1/2 a point reduction in mortgage interest rates. Go from 6.875 down to 6.5, a few dollars a month. It's not changing anybody's life here. The thing that would cause the mortgage interest rates to drop drastically would be a flight to bonds. By a flight to bonds, I mean people lose faith in the stock market and they move their securities money, they sell off their Apple and Google stock and they move it into 10-year T-notes and buy bonds for safety, and that would bring mortgage interest rates down pretty dramatically. That is the type of thing. And usually that starts happening when things are really, really bad in the economy. The other thing is if the federal funds rate continues to drop, and we take probably another year or more to get it low enough, if your high yield savings accounts drop low enough to the point where you're gonna get more on your money in a bond than you will in a high yield savings account, a lot more, then people will move that money out of high yield savings into the bond market, and that could bring down those mortgage interest rates. But really, the economy has to get really bad, the Fed has to get really aggressive with drops, or the stock market has to really just crud out on everybody, which would be because the economy got really bad, before we'll see that money moving into the bond market to reduce our mortgage interest rates. So what does this mean? It means by the end of this year, I don't think we see anything better than 6.5. I'll be doing backflips if we get 6.5% interest rates. Over next year, if the Fed continued to do consistent cuts, maybe 4 more cuts, shave another point off the federal funds rate, we lose another 1/2 point. Maybe by the end of next year, we get to 6%. Unless we have some other big financial calamity, but let's not wish for that. What it would take for the rates to get dramatically lower would not be good for anyone. So my prediction here is 6.5%, best case scenario by the end of the year, 6%, most likely scenario by the end of 2026. So interest rates aren't going to help you enough to be the deciding factor whether you buy a house or not. Price reductions could be, if we can get that delisting trend to stop and we keep the downward pressure on prices could get low enough to where that becomes a deciding factor and increases affordability, but we're not going to see much affordability help through mortgage interest rates in 2025 and probably not very much through 2026. So mortgage rates being high and sticky, and the Federal Reserve being kind of caught between managing inflation and managing job loss due to the ongoing trade war and economic insanity, means that we're not likely to see massive cuts and drops there. I think we are stuck at these interest rates for a while. So time to set aside interest rate and make your decisions based on something else. If you're waiting for 4% before you're going to jump back into the market, you're going to be waiting a long, long time. All right, red flag number 5 that I see in the 2025 real estate market is that days on market are climbing. Look, through most of the pandemic, we were like less than 10 days, a lot of times 7 days or less to sell a home. In the post-pandemic higher interest rate market that started around July of 2022, we maybe climbed to 23 to 30 days. Now, nationally, we are at 53 days on market average, and locally here in my markets, in a lot of places, we're at 60 days or more on market. So this has gone up dramatically, and what this means is there are less buyers for each property. It's taking longer to sell homes. The longer homes sit there, the less buyers there are, the more downward pressure there is on price. Now in this market, I've already told you one of the other red flags, we're seeing a massive delisting trend where if sellers aren't getting their price, they're pulling the house from the market, taking their ball and going home. So if a seller has this mindset of the 7 to 10 day market from COVID or the 20 to 30 day market over the last couple of years, and their house sits there for 60 days, they come to a decision-making point where they have to say to themselves, am I going to reduce the price or am I going to pull the property from the market? And right now, about half and half. Half are pulling it from the market, half are going to continue on and sell. And of the half that continues on and sells, about 30% of those are going to reduce the price. Now that is not enough for these larger on-market times to create the kind of price drops that you may be hoping to see as a buyer. We need that 50% delisting trend to get down to 20 or 30%. And of the 70% moving on, we need 50 to 60% of them to be doing price reductions before this particular red flag is going to make a big deal in terms of price for buyers, but it could get there. It's something to watch, and it is a trend trending in the direction of downward pressure on prices. It just has these other competing factors that aren't normally there holding it back, but it is one to watch, and it is one of the things that I am keying into and saying, look, we're seeing price declines. We're seeing longer days on market. We're seeing less buyers in the buyer pool. All of this together would normally be pushing prices down fast if it wasn't for all of that equity and low interest rates and delisting trend among sellers. So we're gonna keep an eye on this, and it's gonna be another few months before we see what force breaks loose and what starts driving this market. My prediction still is that we see continued price decreases over the course of the year, just not as quick or as much as most people expect. Certainly nowhere near as quick or as much as the mainstream news is telling you. And this may not end up being the massive relief in terms of affordability that some of you buyers are hoping it will be. We'll keep an eye on it, and we'll come back and report to you month after month as it goes. All right, folks, that wraps up our discussion of the 5 red flags I see in the 2025 real estate market and what it means for you as buyers and sellers. We have price decreases on the rise. We have inventory on the rise. We have a massive delisting trend among sellers. We have sticky high interest rates, and we have buyers pumping the brakes and saying, I'm not gonna buy anything big right now because I'm nervous. And all of that is coming together to make it a really interesting real estate market. If you're not looking to buy or sell right now and you're dispassionate about it, this is fascinating from a financial perspective what's going on in the market, because it's not doing at all what any of us would expect it to do. If you are in the market and these trends mean more to you, then I hope this video has helped you decide which one of these you should keep an eye on and whether or not you're gonna see the relief that you're looking for as a buyer or seller to decide to make a move in this market. Now look, if you want more information, I recommend you subscribe to the channel and watch our weekly Informed Home Buyer podcast episodes. If you want to go deeper into that delisting trend, you can click this video right here where we do a deep dive into that delisting trend. If you want to see some of our predictions about some of the macroeconomic trends that might accelerate the downward price pressure here in July, you can click this video right here for our July perfect storm. And if you are mostly here for local real estate information but happened into this video and you want to see some of our local towns pitted in a head-to-head battle so you can decide where you want to live, you can click our town versus town playlist right here. Of course, that little subscribes right there. If you've made it this far to the end of the video with me, thanks for watching, thanks for making it to the end, and I'll see you on the next one.